Hey everyone, Dave Keller here with Market Misbehavior. Happy Friday. It's January 9th, 2025. I'm your host, Dave Keller, coming to you from a beautifully sunny Tampa, Florida. This has been an awesome visit down to the Sunshine State. Can't tell you how much I appreciate reconnecting with some colleagues, former colleagues, and friends and peers around the financial industry and the technical analysis community, which is, I mean, has always been just such a supportive and uplifting and collegial community. And this trip has been no different. Also, great to meet some new people, shake some new hands, and meet a number of people that mentioned that they watched the show, which is pretty awesome too. It's a pretty fantastic couple days here. Today's presentations, people like, I mean, Ralph Acampora, legends talking about their take on the markets. But today was a lot about practitioners, right? Money managers, chief investment officers, all that use technical analysis and being able to talk to them about how they approach the markets, what lessons that they've learned, how they make decisions, communicate ideas, manage risk using technical analysis reflects a lot of the things I think we talk about on the show. But it was really awesome to hear how some really successful people, technicians, do it at an institutional level. So a great event, awesome stuff. I'll be doing my best to debrief. It was a 2-day fire hose of awesome content. So I'm going to debrief a little mentally on the way back to Seattle tomorrow, and hope to share with you some nuggets of things that I observed through the course of the days and months to come. With that in mind, it's Friday. This is our mailbag episode. We're going to touch briefly on the market conditions, and I'm going to highlight 5 or 6 questions that I've received from viewers like you over the last week or so. As always, your questions are welcome. Please use the comment section on our YouTube channel for any questions that you have. You're welcome to hit me up on social media, on X, on Facebook, on any of those platforms. Drop a comment there anywhere you can. We'll gather as many as we can and hope to answer one of your questions in our next mailbag episode. Let's start with a brief recap on how things played out today. I was checking in on the markets during the sessions today. I was wondering if I would need to get the trumpet out for Monday's show. It doesn't look like it's to be, but we got close. We got to 69.75 and change. Not quite to that 7,000 level yet. And we did trade a little bit lower in the last 15 minutes of trading. That's good enough to be up 0.2% for the S&P 500 to close just above 69.66. That's your high for eternity. That's the highest level so far. We'll see if this nice strong finish to the week continues next week. But I do want to point out the NASDAQ composite up slightly more, the Dow up slightly less, but all of the major averages, including mid caps and small caps, having a decent update. The VIX remains fairly low. It's actually down almost a full point today. And so that's down in a 14 handle low VIX. And I was talking with one of the attendees today about, just how to think about the markets. And, one of the things we talked about was just as much as there have been things to maybe be negative about, right? When I look back at some of the stuff we've been talking about on the show, second half of the year last year, a number of times I highlighted things that appeared like early signs of a bearish rotation. The Hindenburg Omen, the most obvious example, but plenty of things like divergences, Dow theory, so many things at times look like they might be turning negative. When we keep kind of, circling back to anytime I highlight some negative evidence, 2 things. Number one, there's a set of indicators that I think are really valuable at telling you this is a real issue that you really want to start to think defensively. 2 of my favorites are credit spreads and volatility. Neither of those are signaling anything but pretty good stuff right about now. Through the end of last year, now in the beginning of January, the VIX remains in, 14.5, which is a very low level. It tells you the options market, not concerned about stocks right now. Credit spreads are near all-time lows, or certainly the lowest levels we've seen in the last 3 to 6 months. That's not concerning. Get nervous when the VIX spikes, which means options investors are seeing greater movements in the index, which usually means greater movements lower. Get nervous when spreads widen, which means bond investors are getting nervous. Neither of those things are happening, right? So those big red flags are not being waved yet. The other thing I would say is that it goes back to the simple, approach we talk about, which is trend following, right? There's a reason why we have a market trend model. The market trend model is not built on me guessing what's going to happen tomorrow. It's just looking at the trend. It's a backwards looking model to just measure the strength of the trend on different timeframes. That market trend model, once again, finishing bullish on all timeframes here to finish the second week in January. Our line in the sand of 65.50, we're pretty far away from that right about now. So those signs that would tell me it is clearly a downside rotation, none of those have fired. But the warning signs like volatility, like credit spreads are still pretty bullish and in a clear bullish range. So what I was taught is, number one, define the trend. That's what we try to do. That's why we have a market trend model as the first chart we look at every day. No joke. But I was also taught to think critically and think as a contrarian and look for signs that maybe my thesis is wrong. And so anything I'm seeing that's bearish, those are things that I think, all right, these could be the things that may lead into something more significant. We've not had that downside follow through. And I think to date still remains pretty constructive here. In terms of rates, kind of a different shift in the curve, the longer end coming down a bit, the shorter end popping up a bit. So a bit of a slight flattening in the curve today. The 10-year yield finished the week around 4.17, the long bond just about 4.8%. Bond prices in the form of the TLT up about 0.2% today. The dollar having a decent day, up about 0.25% using the UUP. Looking at the commodity space, gold and silver both up. I mean, silver had a pretty rock star week, continuing to push up to all-time highs. Gold having a pretty strong week as well. Silver continuing to outperform gold on the upside, as we covered a number of times recently. Copper prices up, crude oil prices up, natural gas down significantly. The energy sector, not a particularly great day. Jay Woods, by the way, CMC contributor, fellow CMT, who's at the conference here today, made some great comments about crude oil and just, what it means when ExxonMobil's, jumping higher, Chevron's jumping higher, but crude oil still remains very low. And so the upturn we've seen in some of those energy stocks, not really mirrored by strength in crude oil prices. And I think today, just more of the same there. Cryptocurrencies kind of dribbling, limping into the weekend, I guess. Most of the top 10 coins tracked here on stock charts were in the red today, but not by much. Bitcoin down about 0.5%, about the same for Ethereum as well. Not much of a story there, I would say. Looking at the 11 S&P sectors, materials number one up 1.6%, technology number two up 1.33%, utilities up 1.25%, about the same for the XLY. That's consumer discretionary. On the downside, you had healthcare and financials, the only two S&P sectors in the red, but not by much. 0.5% for healthcare, 0.33% for financials. To completing our quick sort of abbreviated market recap, breadth was kind of meh. I mean, it was generally positive, and we look at the New York Composite Index, 61% up, 37% down. So not bad, but not exceptionally strong. Home builders had a nice recovery day today after a fairly choppy week. Broadcom, after giving back a lot of recent gains here, popping up about 3.8%. Tesla having a nice counter trend rally after a fairly uncomfortable week, up 2.1%. On the downside, Netflix continues to be the most negative chart out of this bunch. I don't think it's even close. Here's the S&P 500, as we mentioned, making a new all-time high today, a new all-time closing high, not quite above 7,000, but that's not too far away. One easy up day on Monday would clear it. The RSI finishing the week slightly above 60. Out of all the things I'm going to tell you, besides the S&P making new highs, in terms of what's most bullish here, breadth improving generally, I would say the RSI pushing above 60% is pretty good. Or 60, not 60%. That's a value of 60, I should say. All right, on the right side, we have some key measures that we track. I mean, all of these are in bullish readings, right? So again, when I evaluate the conditions here, conditions are good. I can tell you a bunch of reasons why I think the market maybe should not go any higher, but it is, and that's what's most important. You don't get paid on what you think is going to happen. You get paid on what the market actually does. That's why we focus on momentum. That's why we focus on trends. And when I look at the chart of the S&P, it's making new highs. When I look at the advanced decline line on the New York Stock Exchange, it's making new highs. When I look at the stocks above their 50-day moving average, we're up above 70%. Now, that actually could be a problem. And before you get too excited, remember back here We got up to 80%. That was in mid-May. That was before the next 7 or 8 months just continue to rip higher. So it's not necessarily a bad thing that we have that many stocks above their 50-day. Above 50% is usually pretty good, but getting above 70% and breaking below, that's when we can have a tactical pullback. We'll look for that next week. Bullish percent index in good shape. Offense over defense, tilting toward offense over the last 6 weeks. Conditions are good. The market is finishing this week in a position of strength. Make no mistake about that. All right, shall we continue on? As a reminder, this is a mailbag episode. Let's get right to the questions. These questions all came from viewers like you over the last week or so. Just drop in a comment on our YouTube channel. Please consider that. If anything has come up this week that you're struggling with the charts, with indicators, with a macro call, with a particular ticker, use the comment section on our YouTube channel. Maybe we'll feature one of your questions next week on the show. With that in mind, here's question number one. Dave, thanks for the video on RRG. What does tail length equals 4 mean in the upper left corner? And what is its significance? So Julius Acampora, creator of the RRG, who's in attendance here at the conference, had a number of conversations with him as always. And great stuff. And there are a number of presenters that talked about using the RRG. And Julius had a great presentation on that yesterday. And also just, money managers talking about how they use RRG to think about rotation, using it in conversations with clients because it's a great way of visually representing that rotation. So, great reminder of the value of that visualization. So your question is, what does that mean? Tail length equals 4. Let's go, where do I have that? I have it here. I usually talk about it in my weekly flight plan. So here's the weekly RRG. I had a great interview with Julius on the podcast back in December. If you missed that, we talked a lot about some longer term rotations away from growth into value. Really good conversation. Great an opportunity to see and hear how someone like Julius actually uses this visualization every trading day. You're talking about this thing up here, which says tail length 4. So here's the thing, right? The RRG, when you bring it up on any platform, we're looking at it here on stock charts, but I know the folks at Optima have a really good version of this because I use it on my PC at home. Other platforms, Bloomberg obviously has it, and many others. There's a couple different ways you can use this visualization. The tail length, and you have a slider on stock charts, you can move it. It's basically how many weeks or how many days, whatever periodicity you're using over here. It's basically how many dots, how many periods back are you looking? So the RRG itself is based on relative strength, and it's based on indicators derived from relative strength. So in reality, it's actually bringing in quite a bit of data because that's what the relative strength line is showing, right? It's looking at the performance over a period of time, essentially, is what that ratio is looking at. So it's already bringing in a good amount of data, but this is basically how many weeks back do you want to show? So I usually default to 4, which means I have a tail so I can see where it was the last 4 weeks. And I do that so just at a glance, I can see that XLV healthcare is in the improving quadrant. And I can tell by including the last 4 observations that it's heading northeast. It's heading in a constructive direction, which means it's starting to, the momentum is improving and it's heading toward the leading quadrant. Anything to the right of the y-axis means it's outperforming using the methodology on there. But you could also bring in much larger tails. The reason why I don't do that is because you can see it very quickly gets incredibly hard to figure out what's what. This is this sort of spaghetti chart. It's kind of hard to figure out what's what. So I wouldn't do any more than like 6 weeks personally. And I've learned generally to keep it to around 4 weeks. Now, the other thing you can do that's really cool is, and which I would suggest trying sometimes, is go down to like 1 week or 0, and then you can just push play, and you can actually see how these things are moving on time or over time. That actually, to be honest with you, I think is the coolest way to use the RRG. And this is something I talked with Julius about years and years ago, which is why now you can animate these things. You can actually see how the sector or whatever you put on here are rotating over time. That's really the benefit, and that's what you're trying to do. The reason why you can, just do this is because if you're just looking at a static image, I like to see where we're at, and I like to see where we've come from. And that's kind of the idea of what I think makes the most sense. But keep in mind, you can obviously use tail length to change the number of look back periods. Just gives you a good starting point with which to analyze whatever sector ETFs or whatever other things you're looking at. So that's what tail length represents. And again, I like to look at about 4 weeks as a default. Next question. And I tell you what, as I bring up the next two questions, which are related to Bitcoin, one thing that I'm not kidding came up incredibly little. I mean, very rarely. It did come up occasionally, but not nearly as much as I would have thought, was Bitcoin and cryptocurrencies. I've attended conferences where it's almost like a Bitcoin conference. You're like, oh my gosh, why are we talking about crypto so much? This was not one of those. And I think that speaks to the deterioration in the chart. This is a room full of technically oriented investors. We're all looking at momentum. The momentum's just not been in Bitcoin and Ethereum. It's been in gold. We talked a lot about gold and precious metals. We talked about growth stocks, of course. We talked about rotation into value. We talked about non-US markets. There was more discussion about developed Europe than there was about Bitcoin. And I think that is a sign of the times in terms of the momentum differential from something like Bitcoin struggling on a relative basis versus things like, developed Europe, for example, EFA. With that in mind, let's take a question or two. Bitcoin made a bear flag pattern late November till mid-December, and it broke below the lower trend line of that flag in mid-December. Is that bear flag pattern now negated or not? Great question. All right, so you're saying late November to mid-December. Take a look here. Here I've got a good chart of Bitcoin, which is kind of the one that I probably showed on the show. So let's go there first. Here's Bitcoin, and you were saying November to December. There's that bear flag pattern, and the question was, hold on a second. Where are we going there? There we go. Right. So you're talking about this bear flag right here. And I didn't really show the upper, I just showed the lower trend line on this chart, but I think what you're talking about is this. Let's show both of these. And it's not a perfect bear flag, but this is what we're talking about here. And boy, people have called me out on saying bull flag instead of bear flag and bear flag instead of bull flag. I tell you what, one of the things that I think is most annoying about the vernacular of markets is that the thing for something going up and the word for something going down both start with a B, and it is very easy to just talk between those two and mess them up. So I apologize if I mean bear flag and I say bull flag someday. So sorry, it's unintentional, and thank you those that catch it and let me know. You're right. I'm very much not perfect on that. I wish I was better, and it's so easy to mess that up in the heat of the moment. This is a bear flag pattern, which is when you have a downtrend, you have this short counter trend move to the upside, and then you have a breakdown below the lower boundary. So your question is that bear flag still active? So it's like yes and no, right? I mean, not really. And I think the reality is, and this is why price patterns are not the primary tool that I use to analyze markets. I know some people that are, just really look at price patterns as their primary input. That is not me. I find that way too subjective. For me, indicators like, just support and resistance levels, trend, moving averages, momentum indicators like RSI are all more important than price patterns generally in my process. However, many people notice very clear patterns. Many people act on them. And that's why I found a long time ago it was important to recognize them and just be aware of them. Having said that, Justin Mamus, and I'll paraphrase his quote, many, many decades ago, said something like, if a stock doesn't do what you expect it to do, a stock when you buy, it doesn't do what you expect it to do, sell it. And his point of that quote was basically something like a bear flag pattern. What you're doing is you're basically saying, all right, this breakdown means we've had this big move down. We now have this counter trend rally. We've broken down, which means we should be going a lot lower. And that happened for like a week. It looked like that bear flag pattern was really spot on with what was happening with this chart. But since then, Bitcoin has actually done the opposite. It's actually drifted higher. So once we start getting back into this range, and once we start retesting the swing high, I don't think that bear flag is kind of the story anymore. Now, that's not to say that Bitcoin can't go down again. But at that point, does that mean, the bear flag was right? It was just delayed? Like, no, I think that pattern is no longer the most important thing. I think it's important to kind of reset. So when you have a pattern and you have like an idea of what that might mean, and as long as it continues following through, I think that further validates that that pattern was kind of the right call. That was the right structure with which you should understand that stock. I don't think that's what we're seeing with Bitcoin. I think that bear flag is really the most important thing on the chart anymore. Now I'm more interested in what's happened with a break above the 50-day and a pullback to that 50-day moving average. I'm more interested in this swing high from December and the fact that we retested that for kind of a double top. So now I'm looking at a break below the 50-day or a break above these swing highs. Like for me, that's the story now. I think the bear flag is no longer particularly valid. Now, some may disagree with me, and some may have a time frame with which, more of a systematic, more of a structured way that they would consider a pattern valid or not. I've worked with people that do that. But for me, no, it's more subjective. Now compare that, right? Flip that over. And that's like what happened here. This was a perfect example of a bull flag, which is a rally higher, this pullback of lower highs and lower lows. See how that looks kind of like the opposite of that pattern. Now, in this case, we did follow through, right? We broke out of that pattern to the upside, and then we just continued up. So it was like valid bull flag. That was a great call. Bull flag is active. We just didn't get that follow through after the breakdown of the pattern there. So for me, no, I don't think that's the most important thing on the chart anymore. Continuing with the theme of Bitcoin, can equities advance in a bull market while Bitcoin is deteriorating? It seems like Bitcoin has been resembling equities behavior for the last 1 and 2 years. It's hard to imagine them moving in different directions. I love this question so much. And a version of this question came up in the conference I'm attending. I think it was yesterday. Because one of the strategists, might have been like Gina Martin Adams or someone, had talked about Bitcoin among a bunch of other things, basically talking about cryptocurrency. I forget who it was, to be honest with you. I apologize. Maybe John Colovis mentioned this. There are a number of really awesome presentations, and I need to go through my notes in great detail at some point when I have the time. But one of them had talked about cryptocurrencies. And, I think we get into trouble when we think that stocks can't go up because Bitcoin isn't going up. That's the same trap as stocks can't go up because gold's going up, right? If I told you gold's going to go up 60, 70% in 2025, does that mean stocks are going to go up or down? Like most people would say, that probably means stocks are going down, right? If the ultimate safe haven of gold, the hard asset of hard assets, is going up that much, that means a raging bear market. That means inflation's probably completely out of control and stocks are getting crushed and other risk assets. Gold went up and stocks went up together. It is very easy to think of the markets as a simple system and think that stocks and Bitcoin, both as kind of risk assets, should generally be trending together. A lot of times that's happened, right? If you think about the chart of the S&P, I don't overlay it here, but I mean, pretty strong January into February through April, they both were going down. They both bottomed out early April. They both rallied, and going into like October, it's like they are highly correlated, but those correlations completely came unwound. Now, bears on equities that I have talked to, and there aren't many, but they're out there, would cite this as an easy example, kind of to your point, at the point of your question. They would say the rally in equities is unsustainable because Bitcoin is so weak. I get the argument for that, and I understand that. And I think thinking of Bitcoin as a form of speculation, and this is showing you that the speculative pressures are not very bullish. Like, I get the argument. However, I think we run into trouble when we think of a simple relationship like stocks and Bitcoin and assume some relationship that is just not always true. There are times now in the recent history of Bitcoin where stocks and Bitcoin have gone up together. There's times when they've gone down together, and there are times when they've done different things. And I think this is one of those times. I think it's much more important to recognize a breakdown in the price of the S&P 500, the price of the index itself, as opposed to showing the weakness in Bitcoin as a reason why stocks should kind of go down. That's how I would think of it. Great question. I'm sorry. I'm just realizing I had the question going up the whole time. I'm on my laptop in a hotel room, so the setup is not as awesome as I have in my home office. I'm excited to get home, flying home tomorrow morning to see the family, and also to get back to my awesome home office with all of its great tools and stuff. All right, next question. Do you think Costco is undervalued? I love that question so much because valuations are so fascinating. What you have to remember, right, is when a price goes down, what does undervalued really mean? That basically means that the price of the asset is very low relative to some form of value, whether that's earnings, right, which is the PE ratio, whether it's revenue, which would be the price to sales ratio, whether it's book value, which is interesting for like a bank, or cash flow, price to cash flow, or price to free cash flow, or price to whatever you want to put in the denominator, right? It's all about how much am I paying for $1 of blah, whatever that denominator is. So the reality is, anytime the price of a stock goes down a lot, it's going to be easy to call that undervalued, because the price is down, right? Earnings probably haven't changed a lot. Well, maybe they have, but oftentimes they have not a ton. And so the price is going down and the denominator is kind of remaining relatively stable. And if that happens, all of a sudden the PE ratio or the price to sales ratio, whatever, it gets very, very low very quickly, or a lot lower, because of that. Does that necessarily mean it's bullish? Now, the Warren Buffett approach would say, yeah, right. Undervalued is pretty good, because that means you can buy something, and pay less for what the company or what the thing is actually worth. Valuations, though, I think are a dangerous trap, right? On the way down, I think it's a way to justify buying things way too early. Price goes down, we see it as being undervalued, and that's when you're buying a falling knife. That's when you're often way too early on a stock, because you see the low valuation. You don't remember that the valuation can keep going lower, right? The price can go lower and lower, and it's still even further undervalued, right? If I love it at 50, I like it, or if I like it at 50, I love it at 40 is the joke, right? As price keeps going down, I love it more and more. That's not how I invest, and that's not how a technical analyst is trained. You're trained that price goes down for a reason. So wait for the price to stop going down or to hit some important level. On the way up, valuations are also, scare you away from uptrends that last really, really well, right? So if someone told you Palantir is going to be trading at the ridiculous valuation it is today, you'd be scared out of that, purchase, right? But it's been overvalued, quote unquote, for a long time, and the trend has been very, very good. So trend following often does not agree with the general premise of valuation, which is to use that valuation as a timing tool. I think it's more descriptive than anything. So I would think more about the chart of Costco, which what encourages me about the chart of Costco is not the low valuation that we've had. It's the fact that the price is no longer going up. It's the fact that we're actually making a higher low and now a potentially higher high. We're getting above the 50-day moving average, the RSI pushing above 60. For me, it's not about, getting excited down here when the stock is down a lot. It's here when the price has actually started to turn higher. That tells me someone besides me is starting to be a little more optimistic on the stock that's not been working for so long. So for me, it's less about being undervalued, more about the trend going from negative to positive. And I think we may be seeing that play out on the chart of Costco. Next question. I have traded into ticker SANM several times and too often gotten quickly back out due to wild swings. I noticed that institutional ownership is over 99%. Does that change how well technical trading works? What an awesome question. Thanks so much for that. Whoever sent that in. SANM is Sanmina. This is an 8 billion market cap technology stock. And here's the chart. So great chart, right? If you look over the last 12 months, the stock is up quite a bit. I think to your point, you're probably talking about these pullbacks here, and you've gotten scared out of them because it's pulled back a number of times. And the 21-day EMA is often an initial stop for me. You can see that's been triggered a bunch of times here. So a couple comments on this. Number one, in terms of the chart, what's funny about the chart of SANM is it almost looks like it's charted upside down. And if I flip the chart over, this actually looks more normal, because stocks tend to go up and down in different ways, right? Stocks tend to go down very suddenly. They tend to go up very gently. So when you flip the chart of SANM over, it almost looks kind of normal. It looks like a normal chart to me. But if you look at it in the normal way, it looks awkward, right? You have these big spikes higher and then kind of this choppy downdrift, and then a big spike higher and then this choppy downdrift. So Sanmina is almost trading in a very different way, right? Something's going on with stock. And I don't know this company. I'm not a fundamental analyst. I'm not going to speculate as to what's happening there. If you do know and you have an idea, please drop a comment. I'd love to know more about what the story may be and why this chart may look so unusual and look like it's on an inverted price scale. But I would tell you, so I would say the price action is kind of strange. It's not looking normal to me. I would wholeheartedly agree with these pullbacks that are very choppy, and I think that is unfortunately, that's the nature of some stocks. The volatility is a little higher than normal. You have these big moves. You have a lot of gaps on the chart. You pull back and stops are triggered, and then very quickly the market continues higher. That's just the nature of one of these names. I think it's a tough stock to trade as a result of that. All of that is true. To your other question is, what does it mean that there's 99% institutional ownership? So I looked into that, and it is pretty high. It's almost 100%. So what does that mean? So institutional ownership is a data set that exchanges usually provide. I think the NASDAQ reports that, if I remember right, along with like short interest and stuff. They report some data points on ownership. Here's what you have to remember, though, right? It's not, I mean, if it is like 99%, it's not actually true, most likely, that 99% of the shares outstanding are indeed owned by institutionals, and only 10% of the stock out there is owned by individual, or 1% is owned by individuals. That's probably not true. What you have to remember with that institutional ownership data set as it's reported is short shares basically get double reported. So this stock is most likely has a higher than average short interest ratio. There's probably a lot of short interest right now, which means a lot of investors, probably big investors, are shorting the stock. What that does is, when, if you think about what it means when you short a stock, right? If let's say SANM only had 100 shares of stock, shares outstanding, which is obviously impossible. But let's say it's true, right? They only have 100 shares and Dave owns all 100 shares. You want to short that same stock. So what happens is my broker takes my shares and loans them to you, and then you borrow them to short them. We're both institutions. We both report those 100 shares on our books because we both have to report it as owned, because I own them, and I have them with my broker. My brokers lent them to you, so you own them so that you can short them. So the short, or the institutional ownership, would be 200%, because we both own 100% of it, basically. So it's kind of this weird thing. So when an institutional ownership is super high, and it probably could theoretically be over 100%, although it's not very common. I don't think that would happen often, but it probably could in some instances. That just means a lot of people are borrowing the shares to short them. So my guess is there's a lot of short interest. So what does that mean? Well, that could be part of what we're seeing with the weird chart action is what's called a short squeeze, right? If the stock would pop higher, all those investors that are short could get trapped in their short position. They have to close their short. That basically causes a synthetic buy trade, as they have to buy to cover their short position. That causes further demand, which means my shares are worth more and the price can go higher. So that's a lot of speculation. It's hard to really, I don't know the answer, because I don't know exactly who owns these shares and what all they're doing with them. But that would be my assumption based on my experience. Number one, the chart's just a weird chart. It gets triggered a lot. This is a challenge with higher volatility names, and SANM certainly seems to be demonstrating that. The high institutional ownership most likely means a lot of shares are short right now, which means there's a lot of investors kind of betting against the stock. And that could be part of why the stock is kind of gapping in these weird ways, and also could mean a short squeeze. If the stock would start to break out, those investors trapped on the short side would have to cover those, and that can be a good thing if you own the stock. That can actually propel things higher. All right, last question, then we'll call it a weekend. What candlestick patterns do you recommend that I learn? I'm very new to all of this. Thank you. So first off, thanks so much for watching. I appreciate you asking a kind of a beginner question. Those are always welcome. I enjoy greatly teaching investors. A lot of the content that I put out kind of assumes that you know a good amount about charting and technical analysis, or some of the stuff I talk about is probably way over your head, and I apologize for that. But those are the people I'm generally trying to help. That doesn't mean I'm not happy to help someone who's just kind of getting going. And I hope, if nothing else, what we talk about on the show inspires you to learn more. That's my kind of subtle goal, as always. So what things should you own? I'll tell you what, let me do this to the screen. I hope this makes sense. I jotted down a couple basic patterns. Here we go. I hope this works. I'm doing it on my laptop, but here's the two I would start with, and you're inspiring me. I hope to do a number of videos on candle patterns here in 2026. Maybe I'll do a little short course for this and share it as well. But These are the two I would start with out of hundreds of candle patterns that are out there. And I will tell you that John Murphy's book, Technical Analysis of the Financial Markets, has a great, visual representation of these patterns, among others. There are other books like Steve Nissen's books that go a lot more in detail on other candlestick strategies. This one on the top, this is a hammer candle, right? This, you basically have a downtrend, you have this candle, and then you have an uptrend. And this candle, basically the open and close are near the highs. You have a long lower shadow, limited upper shadow. That's called a hammer. Think of it as like hammering out the bottom. You flip everything I just said over, and that's called a shooting star candle. So you have an uptrend, you have the open and close near the lows of the day, a long upper shadow, no lower shadow. That usually means a downside reversal. So that, basically, think of that as like the trend is going, and then you have a big long shadow in the direction of the trend. And that means a short reversal to the upside. That's a hammer candle, and that's a shooting star candle. These on the bottom are called engulfing patterns. Again, in a downtrend, you have a down day and an up day, and day two's body, what's called the real body, the open to close range, engulfs day one's body. That's called a bullish engulfing pattern. This is a bearish engulfing pattern, which would happen in an uptrend, the market going higher, big up day, big down day. Day two's open to close range engulfs day one's. That's why it's called an engulfing pattern. That's a downside reversal. I would start with those and see where that gets you. Best thing you can do with patterns like candle patterns, they're short-term, really swing trading type of patterns. If you're like more of a position trader like I am, I still think they're very valuable because it helps you understand that short-term time frame, which is really good for execution, really good for thinking about the tactical, entries and exits, but helps you understand how the stock and how investors may be relating to a particular key level of support or resistance. But I would start with those, see how they go, and then go from there. Awesome questions. Thank you to all of you that watch the show. Thank you for all of you who have dropped a question in our comments section. If you haven't done so, why not now? Why not you? Why not today? Drop a question, and we'll hope to answer a question in our next mailbag episode. Should be next Friday. In the meantime, have a wonderful weekend. Best wishes and safe travels to all my CMT colleagues traveling from Tampa back to wherever home is. I'll be flying back to Seattle first thing tomorrow morning. Jacked to get back to the comfortable winter weather in Seattle. Excited to see my family, but we'll be looking forward to being back with you on Monday, January 12th. Have a great weekend. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take care, folks.